Next up is the results of Cashbuild. Now, Southern Africa's largest building materials retailer, Cashbuild, reporting interim results showing a 2% increase in revenue to 3.3 billion rand. Headline earnings per share up just 1%. Now, Cashbuild CEO Werner de Jager joins us for more. Did I get that right?
You got it right.
Tell me, very close to the flat line, 2% up. How close was it? And is this the worst that you have seen in the last 2 years? Are we back to 2009 in terms of the operating conditions where you are now?
Godfrey, no, I don't think we're back to those type of conditions, but yes, it was a tough half for us. It's not up to what we normally expect in terms of revenue growth. All in all, when you look at the results, our operating margin of 5.9% is one of the best that we've had in the last few years for a half, and so we're quite pleased with that. But on the headline earnings being down by 1%, we are disappointed about that.
Absolutely. I was looking at the numbers, and you say the 2% increase is actually due to the 7 new stores that you introduced. If you actually hadn't opened up those 7 new stores, so the revenue growth would probably have been flat or below. Why can't you increase prices?
We have increased prices by about 2%. The inflation in our sector is very low, and we've managed to maintain our gross margin, which means that cost increases that we had on the cost side, we've managed to pass over to our customers. You know, but we're getting more and more pressure from imported products and inferior imported products that is hitting the market everywhere, and it's quite tough to trade against that. Yeah,
characterize the competition for me, because you know, as a consumer, when you walk into a store and you see the price of that product that you bought last week, now the price is different, you think, oh, these guys, all they do is just increase prices.
Yeah, you know, the competition is quite fragmented in our sector. There's a few national players, and then we believe between 3,500 and 5,000 independents. That's really the guys that's giving us a hard time in terms of trading, that have got a short time in decision making and doing things very quickly, and they are the tough guys to trade against.
So I guess maybe the Competition Commissioner is not going to be looking at your sector in a while. Certainly things are tough in there. You don't need a policeman checking up on your prices.
For sure.
Okay, let's talk about store growth, because you added 7 new stores here, and yet in your statement you say that you are potentially looking at increasing your presence across the country. Now, in this environment, one would think you want to consolidate and perhaps, you know, maybe shut down a few stores here and there, but here you're saying no, you're actually going to try and see if you can still grow and add more stores. How many, how long, at what cost?
We typically, you know, we want to grow our store base by about 10 stores in a year. We haven't been successful in the last few years. We've been trading for the last 2 years. We've been trading at 191 stores. So for this half, we managed to open 3 stores. And for the second half, we're looking at 6 new stores, and that will bring us to 200 stores at the end of our financial year come June. And we've actually also invested in our existing store base, and we relocated 4 stores and we refurbished another 12 stores. You know, so whilst times were a bit tougher, we focused on our stores and improving them and investing in our stores.
We're talking South Africa now. What about the rest of the Southern Africa and the continent?
We're currently trading in Botswana, Lesotho, Swaziland, Namibia and in Malawi. You know, and there'll be limited store growth in those countries. We're busy opening a new store in Malawi, so that we'll have a second store in Malawi. There's some activity in Swaziland, and but it's 1 or 2. But the big growth for us in the current territories would be in South Africa. You know, we believe that we could get to a store base of about 300 stores in the current territories where we are, and I'm not going to commit to how many years, but at the 10 a year, one could see 10 to 12 years, we hopefully will get there. Yeah,
I hear you very carefully not saying anything close to the equator or north of the equator. You're not interested in those parts of the continent?
No, you know, our model is we don't have a central warehousing, and we get direct supplies from our suppliers, so it's difficult to move our model far from where we are. You know, so the logical next steps would be our neighbouring countries, the likes of Zimbabwe, Mozambique and that, but there's no firm plans at this stage to move into those territories.
Yeah. I was looking at the type of customer who comes to you. Now, you're talking about a home builder and improvers, contractors, farmers, traders and large construction companies. Then of course there's always the government related infrastructure spend. So a diverse group of a customer base, but at the same time, I think what's worrying is that you're seeing pressure across all segments, or is it part of it?
No, we're actually seeing it across quite a few of the segments. You know, Bakkie Builders is the one crowd that we haven't spoken about in there, and they make up a big part of our revenue. You know, they service you and me and do renovations and all those type of things, and that's where we see some real slow growth coming from. And you've seen recently what's happened to renovation plans passed. It fell quite substantially. But you know, we've seen, talking to suppliers, that on the timber side, on cement side, and paint side, that things are down and flat. You know, so we believe that we are still there or thereabout, but certainly not pleased with the performance, and we'll do lots of actions that we've taken to improve the situation.
Yeah. So fair to say that margins are going to remain under pressure in the next half and perhaps for the rest of the year. I mean, I was looking at your numbers again, and one of the things that stood out for me is stock levels are up 10%.
Yeah, that was a planned move from our side. We heading into December, you know, we've never been 100% successful in stocking our stores for the closure when suppliers close later December and early January. And you always sit with stock shortages in some stores in January. So this year we planned it properly, and we stocked up in all the stores and made sure that everybody ordered according to their suggested order quantities. And that's why the increase in the stores.
So it's not because of sluggishness and that kind of thing related to demand. What about the stock trading days, up to 70 versus 60 in the prior reporting period? Are you seeing perhaps a deterioration on that front? No.
No, you know, we pull statistics of slow-moving stock and all those type of things, and all those statistics are well under control, and there's no issues on that side.
So, sum up, if you can, the next quarter for us. How tough are things there, and what strategies are you putting in place to make sure that, of course, those margins remain under pressure, because we've seen inflation is not going anywhere here?
You know, just before I said it, on the inflation side, we do expect some pressure coming from the fuel prices, and previous gentleman also mentioned some of those issues. But you've seen our first 8 weeks we were trading 1% below where we were trading the prior year on that front. So it is depressed for us. We're not expecting a good quarter. Although the real pain was in January, we were down there 4.8%, and we're up now in February again to the tune of about 3%. So all in all, the trend is continuing, and we believe it's going to still be a tough quarter for us.